Hello again. Let's continue the presentation on Worldcom's accounting scandal. The audit committee later notified US regulators about the fraud, which later discovered that Worldcom had actually overstated assets by $11 billion. The company soon faced civil charges and its key executives were indicted on charges of securities fraud, conspiracy, and filing false documents with regulators. By end of 2002, Worldcom was declared bankrupt. The CEO was jailed for 25 years, the CFO was jailed for 5 years, and the controller was jailed for a year. While justice was eventually served, could the scandal be detected earlier? It is clear that Worldcom internal audit team was a hero in this case, having displayed high level of professionalism and integrity, which can't be said for the management team and accounting department. Worldcom's former auditors, Arthur Andersen, was also largely at fault for not carrying out due diligence or even the most basic auditing procedures such as checking its capital expenditures. Arthur Andersen's failure to identify Worldcom's weak internal control and obvious red flags reflects the poor controls within the firm to conduct proper audit procedures. While KPMG was new to Worldcom, they are not entirely faultless, as they should have known about Arthur Andersen's role in the Enron scandal and could have taken the necessary precautions to understand more about Worldcom's financials. Let's look at 3 internal control recommendations that would have detected or prevented the fraud. Number 1. Professional skepticism, having a questioning mind and to resist the temptation to just accept the easy answer. Being alert to anything that may indicate misstatement due to error or fraud. And critically assessing audit evidence, which is to go beyond simply providing evidence to support disclosures. Number 2. Look for significant risk transactions, which are risks of material statements that, in the auditor's judgment, require special audit consideration. These are usually items that are unusual or one-off, example, property purchases and sales. Had the auditors inspected Worldcom's capital expenditures, they would have found the fraudulent entries. Number 3 is to conduct proper audit procedures, whether it's through analytical procedures or test of details through substantive procedures. This will include examining material journal entries as well as examining other adjustments made in preparing the financial statements. Now, what's surprising about Worldcom is the very basic nature of what happened. The transaction of obvious expenses into capital expenditure is absolutely fraudulent. If the company is paying a service charge to lease local lines, that's a clear expense. Certainly, auditors can't audit every single line, but even an application of basic sampling techniques should have unearthed this kind of entries, something that Arthur Andersen did not do, and if they did, could have easily detected the entries as the amount was substantial. Hence, the Worldcom scandals could have been avoided had the auditors simply adhere to the professional standards that are expected of them. This concludes my presentation. Thank you for your time.
Created using Powtoon.